Bismillahir Rahmanir Rahim. Alhamdulillah. Wassalatu wassalamu ala Sayyidina Rasulillah wa ala alihi wa sahbihi wa man wala. Welcome back to another discussion of modern transactions in this course on modern transactions. So today we're going to talk about stocks, the stock market, and a little bit about financial markets. And the stock company is one of the earliest forms of modern commerce, modern banking, modern meaning like back to like the 1600s, that is. And it was a way that the Europeans devised, I believe it was also the Dutch, and a way for them to increase the pool of capital to be able to carry out larger projects, specifically or particularly transatlantic or transoceanic, transcontinental projects, that is. So projects that are far away that need to be funding and things like that. And there's a whole history, very, very fascinating and very interesting about the rise of these types of corporations. And unfortunately, it's a history that is not very positive. There's a lot of negative things with that history and abuse, and obviously that's not what we're going to talk about, but it bears mentioning. So now we have this company in which you as an individual can own a share in that company. You can own a stock in that company. What does that mean? Well, that means you have part ownership. So hopefully that stock will increase in value, and then you can sell it at a later time, and then you can, make your profits on that. If you are a large shareholder, as we call it, somebody that owns quite a bit of stock, you have an influence over that company at the shareholders meeting. Of course, if you just own one stock like an Apple, I mean, your voice really doesn't matter. It's just you're just holding it, hoping that you'll make some money. But there are peoples or institutions that will own, like banks. We talked about banks the other day that own a large share of those. So this is so prevalent that you might not even pause to think, oh, this is a new transaction. Isn't this the way the world is? Well, it is new-ish in the sense that there was a time in human history which we didn't have that. So we're going to talk about that, the permissibility or lack thereof of dealing with that. What's not in the notes is also something related to zakah that I think it's important to know, because a lot of people ask questions about how to pay zakah on the stocks that they own. So I'll maybe punt that to the end of the lecture. But that's the main topic for today, and we'll jump into it at the next clip, inshallah. All right. So the idea behind the stock company is that we're going to pool our money, and we are going to issue stock to people that buy a share. Usually the shares, in a very simplistic model, let's say there's 100 shares of the company and each person buys 1,000 of those shares, and then so you get like literally a certificate. You used to get like actual certificate that looks kind of fancy, it makes it look semi-official, and then you have that and you kind of keep it in your files, and that's the proof that you own that stock. You give the company that money then becomes the capital of the company, and the company goes and does what it does, and then when you want to sell that stock, you can. Now, of course, that example almost doesn't exist because it's not that simple. First of all, there are classes of stocks. So there's, class A, class B, class C. And that doesn't mean that they're necessarily in that order, because a company has the right, and I know this because I've dealt with a little bit of this on the business side, you can give those different class super voting rights. You can give the classes of stock different price. And something that companies do that's kind of a little deceptive is they'll make the special class, the special stock, the class B or class C, and issue the class A to the public. So the public think, oh, I have a class A stock, but they didn't read the fine line to realize that it's the class B or C stocks that have the super voting rights, that each share is worth like 2 votes or something like that. Anyway, so that's one layer, is that there are different types of stocks within a company. And then the company can split the stocks as it expands and then dilute the value of the stocks, of each individual stock that you buy. Or it could increase it if it goes public, and things like that. So there's a whole, that's business right there. A public company or a company that has stock. Well, actually, I backtrack. It doesn't have to be a public company. Private companies can be stock companies. They just have fewer stocks, and maybe the simplistic model would be more applicable to a private company. But if you think of a big public company that's listed on the stock exchange, they have millions of shares, okay? And And that's because they're operating at a massive level. I mean, some of these companies have larger balance sheets than many small nations. So, and that's why I said in the introductory clip, if you study the history of these type of corporations, there's a lot of darkness there, because these companies were able to gain so much capital and strength that they usurped a lot, not all companies, but they usurped a lot of the natural resources of different, like in Latin America, fruits companies, United Fruit Company in Latin America, and of course the Dutch, what is it? The Dutch English company? I can't remember the name of it. The East India Company, which was basically operating as a state, in the subcontinent and destroying its resources. I mean, I got to be fair. It's pretty dark stuff. But anyway, we're not looking at the politics of it. We're just looking at the basic financial transaction to see what Islamic law has to say on it. So you own a share in this company. Now, either you're going to buy the share directly, so you're going to go to the app or website of the company. You're going to transact money. You're going to link your bank account, and then you're going to get ownership of the share. And then you can basically just do with it what you want. Usually, people that do that hold it, hoping that the company will increase in value, and then therefore your share will increase in value, and then you'll sell it for a profit. Or the other model is that you deputize somebody. There's like a wakala. You deputize somebody to buy it, which is a brokerage firm. And that firm, they will buy and transact and sell on your behalf. Now, people that are super into this, they'll have their screen in front of them all day, and that's all they do. They'll buy and sell multiple times a day. You have to really be an expert for that. That's like a full-time job. And you really need to know about the nature of the company and what's going on, and they call it day trading, and it's a very niche thing, and there are people that make money in it, but usually the wiser, or not that I'm giving you investment advice, but usually the wiser and long-term plan is the better plan, which is you buy in solid companies that are backbone type of industries, and you just wait for that to accrue in a lot of value. Anyway, the point is that my point is that either you're buying the stock outright and you own it in your own self, like you actually have the certificate, or a letter comes in the mail, or like that kind of traditional old-fashioned way, or you're probably most likely 90% of the time going to use some kind of app. Either you're directly buying or you're using a brokerage, because there needs to be a special type of mechanism to be able to purchase. It's not like you go to Amazon and you just buy something and it's delivered to the house. So oftentimes, what you really are doing is using a brokerage firm. Even if you think you own the stock outright, you'll probably notice that the app that you're using is going to take a fee, a service fee, and that fee is a proof that you're not doing you're not going to the Acme company. Acme is just a generic name in English. You're not going to the Acme company and buying, here's $1,000, give me as many shares as it has. You're actually using an app, and therefore the app is the middleman. Anyway, that's important to know, because then that's a tawkil type of transaction that you're dealing with. Now, I'm not so interested in this lecture about voting rights, but the idea is that the company is beholden to the shareholders. It has a fiduciary responsibility. That means it has a responsibility, ethical responsibility, to do what is in the best financial interest of the shareholders. And you've heard these terms before, and that's where kind of a lot of controversy happens. And of course, the larger companies, there are investment banks, or banks like we talked about yesterday, that pool our money and invest it, that own huge chunks, 10% of this company. And that 10%, if Bank of America owns 10% of, I'm just making the Coca-Cola, that 10% is probably hundreds of thousands of shares or millions of shares. So it's a lot. And therefore, because it owns 10% of a company, what Bank of America, in the example I just gave, what Bank of America has to say about Coca-Cola has a lot of impact to Coca-Cola. But if me and you own a couple of shares through an app, Coca-Cola doesn't care what we say. We have technically we have a voting right, but our vote doesn't really count, because there are these big players in the game. So that's also important to know. If it's a smaller company, like a family company, I've seen this before, where patriarch of a family wants to create a business and has like equal shares of the business for his 4 or 5 children, boys and girls. Okay, and then those shares have equal votes. So inside the family, that's an issue. Now, if there's an even number of kids, like 2 boys and 2 girls, each one has a share, each has the equal share voting right, well, that's a problem because there can be a tie. Well, how then do you break the tie? This is not related to the topic, but I just want you to understand how sophisticated this can be. So in a smaller private company, as I said, you can have shares. And in that case, the issues of votings and the ethic of voting and the worth of the share actually is quite significant. But in the large public companies that we all know about, Apple or Coca-Cola or Aramex, I don't know, whatever is in the Middle East, whatever these big things, Amazon, I'm making no judgment about the haram and halalness of each company's actions. I'm just speaking in commerce terms. Your individual vote doesn't matter. Your individual share is just that, your individual share. You hope that it goes up in value, and the idea is that you can cash it in. And usually, like on the iPhone, there's a app tracker. There's a tracker a stock tracker app. Sorry, that manages the big stocks. A lot of people will do that. They'll wait till it goes up a little bit and they'll sell it, and things like that. And then the company is listed, if it's a public company, on the stock market, and then that's what the tracker is. If it's a private company, you're not going to know the value of it unless you're on the inside. But if it's a public company, then you see every day, every hour of the day that the markets are opened across the different parts of the globe where there are markets. You'll see the fluctuating price. Apple has a new product release. It's a smash. The price goes up. The quarterly report comes back. iPhone sales are not that good. The price goes down. That price going up and down, that affects the price of your stock, the individual certificate that you have to sell or to not to sell. And then as the owner of the stock, if it's just a public company, you have the right to cash out whenever you want. So I could buy the stock this morning and then sell it this afternoon. But if I'm an early investor in a company and it's not private, usually they'll have something called a vesting period. So I will invest $10,000 in the startup, and then that $10,000 will vest over a certain amount of time. So after a year, they'll give me X number of stocks. But if I pull out before the year, I might not get any stocks. And if my hope is I'm going to get 100 shares of this new company, and I pull out after a year, they're only going to give me 2 or 3 shares because I didn't let it vest for the certain period of time. So that's a different type of financial structure where it's an agreement. As long as it's al-bay' is al-ijab and qubul, agreement, offer and an agreement. So as long as there's an agreement, then we are beholden to our conditions. And that's another model. But for the purposes of the next couple lectures on this topic, we're going to just think of a simple company where people own a stock, and then we'll talk about the fiqh of it shortly, inshallah. Okay, so you own a stock in a company, one or several stocks, or you own several stocks in several companies because you're trying to have a diverse portfolio, whatever the case may be. There are many factors that impact the price of that stock, and that's where people turn this into a profession, to be professional investors, which is to know that I'm not a professional investor, so I'm not even going to act like it. But we know enough that we can share with you just sort of kind of how that world is. If it's a public company, and as I said, it's listed on a stock exchange, then the trust that the market has in that company will dictate whether the price rises or falls. And that's dictated by financial reports, job performance, sales reports, new products, R&D, new contracts, that kind of stuff. So the people that make this a full-time job, they're studying these things all the time. They're reading them the way we're studying fiqh. They have all of these reports, all of these portals. They have contacts. They're making phone calls. What's going on? They might go to a physical job site if the company is like a construction company, see what's going on, to feel, yes, it's going well, it's not going well. Are they applying for more finance? If they get large amount of finance from an financial institution, that means the financial institution trusts them, so maybe the price goes up. Or maybe they take out a loan because they're not doing so well, finance loan, and then therefore the price of the share goes down. And as the Arabs say, وَهَلُمَّ جَرَّ, and so on and so forth, the discussion goes. The idea, again, behind it is the reason you own a part of the company is that you're hoping that the company performs well and will bring you back some money on that share, that you can sell it, etc. Multiple people can own a share if the laws allow it. You can own as many shares as you can buy up to a limit. So sometimes larger companies will differentiate between an individual investor and an institutional investor. So the institutional investor, like the example I gave, the fake example I gave in the last lecture, Bank of America owning 10% of Coca-Cola, that's an institutional investor. You as an individual, even if you had that liquid cash, you can't just go buy 10% of something like Coca-Cola. You'd have to be an institution itself that has certain backing and checks and balances for something like that to happen. Okay, so when that excuse me. Well, let me talk about zakah now. Maybe it might be an appropriate time as a pivot. In the modern fiqh, we treat stocks as urud al-tijara, trade goods. So whatever the fiqh we discussed on the zakah of trade goods, that's the zakah that you're going to pay on the shares. So you're going to value the shares at the end of the year, at the end of the hawl, and see how much that product costs, because you own, a trade good. And then if it's at the nisab and all of that, then you're going to pay the 2.5% zakah from that. So that's just a little thing on the zakah, because a lot of people ask that question. So if you own stocks outright, like through an app, then you got to monitor that stuff, and you got to just make a little bit of an effort to keep a catalog, keep a diary or a schedule of when that stock came into your possession, how long you're holding it for, and things like that. Now, the different stocks will often carry with them different rules of return. So that's also going to be in the agreement. They usually call that, something like that, the prospectus. And the prospectus is like this little booklet that's full of legalese and business terms that tell you exactly what it is that you're buying. And from consumer protection point of view, those things have to be readily available for individual investors. You can't invest in the Sharia and in the non-Sharia. Both will consider that gharar, too much speculative, unknown. If you were to invest in a company and not have any clue what the heck is going on, that's a problem. So sometimes they'll mail you the prospectus. Sometimes you can download it now that things are going, paperless. And in that, it will kind of tell you what's going on. If you just own the class of stock, this goes back to the type of classes of stock. If you own the common stock, usually it's just called common stock. That's the stock that you're buying through the app. You own the stock, it's in your name, and then when you're ready to sell it, if you want to sell it, you can sell it, and then you just realize the difference is your profit. It's just a very simple transaction. But sometimes there's not common stock, and those stocks, like as I said, they have super voting rights, or they're worth more, or you bought them at a cheaper valuation, but then you got to hold them for longer. So the devil's in the details, as we say in English. You got to read that prospectus, and you have to understand in it what are the details of the stipulations, of what's going to happen and how much money you're going to get. Some companies issue bonds, which we're not talking about here, but a bond is a capital raise for a company or for a government or for a municipality, and they will issue certificates for that bond. So Toyota will issue a bond, and they're trying to raise $1 billion, let's say, and they're going to issue. You can buy this certificate for, let's say, each certificate is $1,000. They quickly get their $1 billion because everyone wants to invest in a company like Toyota. Mashallah, it's one of the best companies on earth, most reliable. And then they will say in the bond raise, in the bond issuing of the bond, Toyota will say, in 2 years or in a year from now, we'll start paying you every quarter X number of money, the principal plus the return on the investment. So that's another type of stock, which is just called a bond. And it's important that you know these terms, because if you're operating in the modern world, look at all the stuff I'm telling you. I just been around a little bit, so I kind of know a little bit about these things, and have some business experience here, talk to lawyers there, accountants there, investors here and there. So you kind of need to know these things because people will ask you these questions. People ask me all the time about how you pay zakat on stocks, how you pay zakat on bonds. So now you know a little bit about that. So the bond, it's another type of stock, but it's the companies that's already established trying to raise, have a capital raise because they want to do something new, launch a new product or invest in a new sector. So they're going to issue, they need a lot of capital now, and they're going to reward you for helping invest in them. So that has like a timeline. That bond will have a timeline, and then after 5 years, your $1,000 will be repaid to you, but you'll get $1,500. Oh, that's too much, but maybe like $1,200 or something like that. So you've made the return on that, so the investment return is embedded in the bond structure. Whereas in the stock, you're buying the stock, they say buy low, sell high. So you're buying the stock now, it's $15 a share, and then maybe in a year, it's going to be $25. Wow, mashallah, $25, I'm going to sell it, I'm going to make that $10 profit off of each share that I own. All of these transactions that we've talked about, the stocks and the bonds, they're all regulated, heavily regulated. They all have to have public disclosures. They all have rules against insider trading in all financial jurisdictions that I know of, even in emerging markets. And there have to be rights protected. Like we said in the last several lectures, without some type of guarantee, institutional guarantee, often governmental guarantee, against the nefarious dealings, no one would trust a company. If a company was I'm not talking about if the company is doing what we would consider halal or haram things. I'm just speaking in abstract terms. In the next clip, we'll talk about that part. If the company is doing some sketchy, funny math, fuzzy math, and there's a lot of insider trading, like you think of Enron, the big Enron scandal. There was a lot of insider stuff that was happening. Mark-to-market transactions, they were calling them. Khalas, the whole thing collapsed literally overnight, and people's whole net worth was wiped out. And those people went to jail actually, and I think actually one of them he might have even died in jail, or maybe one of them died I think even before he went to court. But anyway, it's a very traumatic thing. There's got to be protections. So you have the right to buy it, to sell it. You have the right to inquire. You have the right to get that prospectus. You have the right to buy more. So that's another thing. You buy a stock today and then, it's doing really well, so you buy it again tomorrow at a lot higher price. So now you own them, but you bought them at different prices, and then you sell them and you'll make a profit in different ratios, so on and so forth. So that's got to be important. There's got to be some kind of regulation in that. And then in the next clip, what I want to pick up then is we're going to talk about the Sharia nature of this, because this is so prevalent. It's like owning a bank account. It's impossible not to hear about stocks and bonds. And people always think for some reason that if you're in the stock market, you're going to become rich overnight. So there's a big attraction, especially amongst young people. So let's talk about the fiqh of that in the next clip, inshallah. Okay, so there's a difference of opinion with the modern fuqaha. The more liberal position, which is the position that ends up being taken by these Islamic banks and financial institutions, is its permissibility, because it's just a simple transaction. Embedded in the transaction is the ijab and the qubul. Business transactions, their default position is that they are permissible. And that's the opinion that we follow, and then the banks follow, that it's permissible to own stocks and bonds and whatnot. The second opinion sees the first opinion as sloppy because it does not differentiate between companies that do the haram versus companies that do the halal. In that critique, there is my critique of that critique, which is that the first opinion is not opining on if the company is halal or haram. The first opinion is opining on the concept of a stock company and individual people owning stocks. Is that permissible or not, given all of the things we just said in the last two clips? It says, yes, there's nothing haram about that. It's just a new financial transactions, an amalgamation of little pieces, and that's permissible. That is not to say, should I invest in a beer company or should I invest in a weapons company that's helping slaughter Muslims or something? That's a secondary issue. So this is for me now, kind of going off script. My problem with this entire course and with the sources that the university is using for the entire course, my critique of it, not my problem, my critique of it, is that a lot of these people, a lot of these fiqh opinions critiquing certain modern transactions are very sloppy because they're putting together too many things and saying, oh, a'udhu billah, That's not how fiqh works. When we took all of the fiqh together, I always say that fiqh is a precise instrument. So in the modern world, we have to be equally precise the way that the Salaf were precise. Can you create a stock company, issue stocks for people to own stocks? Is that permissible, yes or no? Yes. Okay, that's issue number one. Now issue number two, how about this company, this company, this company, and this company? That's a separate issue. They're separate af'al because fiqh governs the actions of the mukallaf. So can I create a company and issue the stock, for whatever reason? I mean, I want to have a massive Islamic book operation, publishing and printing and selling. So I need a lot of money up front so I can buy the printing press and the laser this and the laser that and buy the inventory in the warehouse and okay, so yeah, you can do that. That's a separate question then, should I invest in company A or company B? So the critique that the modern fuqaha have of the position that allows it when they say, but you can't invest in a company that has riba or this, but that's not what the first opinion said. They never said you can invest in a company that has riba. They're saying, yes, you can invest in a stock company because the concept of a stock company is not antithetical to the Sharia. I know it sounds like I'm nitpicking, but it's important to state that because I think a lot of the modern Islamic banking fatwa approaches are very weak on fiqh. They're not just weak on fiqh, they're weak on the takyif, on the conceptualization of the modern transactions. And that's a problem. I think there needs to be a lot more work done. I mean, alhamdulillah, they've made some effort, but there needs to be a lot of more work done. Okay, when we put both of those opinions together, without doubt, there can be a haram company to invest in and a halal company to invest in. I mean, that's without doubt. We're not going to invest in a company that's known to do something haram because then you own part of that company. So part of that ithm will come on you. So this is where, I mean, I'm not giving you investment advice, but you're probably going to want to invest in, sectors that are more neutral, whether it's like technology or healthcare or something like that, rather than something like defense or, food and beverage where there could be haram things, overtly haram things. And as I said, usually you're not going to invest directly in the company. You're usually going to invest through your financial institution. And in that process, you will have somebody that you can talk to ask these questions to. So they are the expert advice. And what you need to convey to them are your values and parameters for investing. So then they take your money and then they'll invest it in the way that you want and buy the shares in the company that you want. So that's also important to mention. What else did I want to say? Based on the modern fiqh that allows, I mean, I don't know any individual mufti that doesn't allow this. So when he says there are some that don't allow it, I'm assuming that what they're doing is they're not allowing the investment in the haram companies, okay? Because there's nothing other than, I mean, in the notes that I have, they say that sorry, my microphone keeps slipping. In the notes, they say that there are some muftis that say the problem with owning stock is that it violates the ijab and qubul. But the fact that the company issues the stock, that's the offer. And you buying the stock is you accepting the offer based on the conditions that are printed in the prospectus and the fine print. So if somebody were to actually say that, which I have never met a mufti that said that, then that would just be incorrect because it means they don't understand that transaction. It's one thing to know the Quran and the Sunnah and the Sharia, and then there's a second thing to know the thing today that we're dealing with, and then a third thing to put them together. So if somebody is assuming that there is no offer and accepting an offer, no ijab and qubul in the transaction of buying a stock, well, that's incorrect because they're issuing it, and the state or the governing body is allowing it to be issued because they fulfilled the checked the boxes and complied, and they're legitimate and legal. And that's to the benefit of everyone, and then you are accepting that offer to buy it. So that's a default thing, and that's what the majority on this issue, the majority of the modern position holds. All of these little steps, issuing the company, issuing the stock, issuing the bond, buying it, selling it, etc., all of that's got to be known, ma'loom. If something is unknown, majhul, that's when we enter into the path of al-gharar, speculation, that, as we've talked about, the Sharia is very hesitant and reticent to deal with. So the prospectus actually, I think, from the Sharia point of view, becomes the most important instrument in this transaction. However, in real life, almost no one knows either that word or knows the prospectus, or when they get it in the mail, they throw it away. But that is actually the most important thing, because that's where all of the ma'lumness is demonstrated. The name of the company, what it's trying to do, its values, its mission, its vision, the rules of the different classes of stock, the payment schedule, if it's a bond or if it's all in that prospectus. And that prospectus is what those companies are actually submitting to the financial authorities. And it's the financial authorities that are looking through that stuff to say yes or no to compliance. And when you go to court, that's the debate is going to be, well, we said this on page 16 of the prospectus that, there could be this situation, or there could be a delay here, or something like that. So I have read some of these. I think it's prospecti. I don't know if that's the plural of it. I have read some of them, and they're very, very terse. I mean, it's a whole nother. It's like when you study Sharia, it's another type of language. That prospectus language. It's another type of language. You got to get used to it. So, they're quoting the Fiqh meeting that took place in 1992, which, for the purposes of this lecture, that I'm recording this in 2024, I mean, that's like ancient history, right? so, I mean, if there was going to be a new meeting, I would hope that at the meeting, or as a workup to the next Fiqh meeting, wherever it takes place, Jeddah, Mecca, Kuwait, Cairo, that we have some of these prospecti translated, in the Arabic or something, and then the ulama can actually read them to see what's happening, to get into the details, because that's what's going to have to happen. Okay, not much more that I want to say on the topic, other than the good news, or the positive news, is that with all of these new type of things that we've been talking about, banks, investment, stocks, even though there are differences of opinion, the Islamic banking sector takes the positions and the opinions that allow these issues to happen, because it's such a fact of life that it's impossible to live and to have a functioning society without them. So, again, just to repeat, it's one of those issues where there are dissenting opinions. I'm not going to deny that. But those dissenting opinions are in the balance with the positions that allow. And as long as that there is a difference of opinion, we're going to follow the opinions that allow it for the greater good of society. Wallahu ta'ala a'la wa a'lam wa sallallahu ala sayyidina wa mawlana Muhammad wa ala alihi wa sahbihi wa sallam. All right, so in today's class, we talked about stocks and bonds, actually. We talked a lot more about bonds than I originally thought I was going to. And we talked about a little bit about the history of the joint stock company, and how it might even surprise you for me to say this is a new thing, because anyone that's consuming this video, that's all they know from the time they were born till now. Isn't that the way the world is? There was a time where that wasn't the case. It's a European invention. I believe it was the Dutch that came up with a joint stock company, and it allowed them to fund, massive projects, faraway projects. So, there was the East India Company, and there was the Dutch India Company, of these type of things that did a lot of nefarious things. But the structure of the joint stock company, and then therefore the stock market that would hold and regulate the price of these stocks, emerged. So basic idea is that you own a part of the company. From the zakat point of view, we said that this is considered urud al-tijara, trade goods, and you're going to pay zakat on the stock certificate that you own at the end of the year, just like if you had a store and you had all of these SKUs in the store, products, and you pay the value of the urud, of the trade goods. That's not in the notes, but that's for me because it's a related topic. I wanted to mention that. And I think I might have mentioned that in the zakat class. And then we talked about, I kind of spent a long time talking about the different types of stocks and classes of stocks and rules associated with stocks. There are public companies, but there are also private companies that can be stock companies as well. They talked a lot about the prospectus of a company in which it prints its financial details that talk about the rules of the return on the stock and things, and voting rights and shareholders meetings and all of that kind of stuff. And then we talked about the fiqh of it, that there's a difference of opinion, that the majority of the modern muftis say it's permissible. Some of the muftis say it's not permissible because they saw in a lot of these companies haram activity. And I was critiquing that critique, saying, well, investing in a haram company is haram. No one's going to argue. But we're talking about, can you invest in a concept? Can you create a stock company, issue stock, and invest in a stock company? The majority of position says yes, because that's the basic structure of trade, to come to an agreement between two things. And that's the opinion that the modern Islamic finance sector follows. And those are the main topics we talked about. Walhamdulillahi Rabbil Alameen. Wa sallallahu ala Sayyidina Mawlana Muhammad wa ala alihi wa sahbihi wa sallam.